The Adjusting Process, Chapter 3, Wild 21st Edition. Using the chapter example, we will walk through the adjusting process from the unadjusted trial balance to the adjusted trial balance. We can see here that we've started with the unadjusted trial balance of all of the debits and credits, and that the debits and credits equal. Now we will have to look at the month-end adjusting journal entries. These will be needed to recognize all expenses and revenue before the financial statement date. We notice that in our unadjusted trial balance, we have prepaid insurance. Well, of course, if we prepaid the insurance, it's going to lapse over the time that we've had the insurance in effect. So at month end, a month of the insurance will have lapsed. So prepaid insurance represents 24 months of insurance. 1 month has passed at month end. Therefore, $24,000, which is the value of the prepaid, divided by 24 months means $100 a month is going to lapse. Next, we notice that we have supplies that we have purchased throughout the month in the amount of $9,720. However, we haven't adjusted this account for any supplies that were used during the period. The supply count at month end reveals that $8,670 of supplies have not been used at month end, so they're still in the supply storeroom. So 9,720 minus 8,670 means that the employees have used $1,050 in supplies during the month, so we must adjust for that. Adjusting journal entries are going to be internal transactions. They're not going to be transactions between the company and an outside entity, but they are judgment calls by the accountants knowing what's transpired internally and what must be adjusted so that the final adjusted trial balance, this is the unadjusted trial balance, after we do these journal entries and post them, we'll have the adjusted trial balance. It will properly reflect all of the transactions for the company, and the company's books will be brought up to current status. Next, we know that we have some equipment that we purchased, and we know that as an accountant with experience that the purchase of equipment will require depreciation expense. So the equipment will have to be depreciated. We will use accumulated depreciation as a contra asset account to show the accumulation of depreciation since the time that we purchased the machinery. And also here, since it's a new purchase of machinery, we haven't yet recorded any depreciation expense, which is the expense of using this machinery because we purchased it in order to be able to help us produce income. So now that we're using the machinery, we must take the cost of the machinery into account as we generate income, matching this expense to this revenue. So how do we calculate depreciation? Equipment salvage value is $8,000. Equipment cost, which was $26,000, minus any salvage value will equal the depreciable base. Our equipment cost is $26,000. Our equipment salvage value is $8,000. So this means our depreciable base will be $18,000. And we assume that this equipment is going to be in use for 48 months. So let's look at it on a monthly basis, and I think that's always good for you to do as a student, to always look at these everything on a monthly basis and be consistent in how you approach this. So 18,000 divided by 48 months means that $375 equipment depreciation and accumulated depreciation must be recognized each month. 1 month has passed at month end, so we will recognize this. Now, a word about accumulated depreciation. We are going to use this account when we do the journal entry for depreciation expense. This is a contra asset account. It is in relationship to the equipment costs. And we will see that on the balance sheet, accumulated depreciation will be associated with equipment, and it will show the net value, which will be the equipment cost minus the accumulation depreciation that accumulates throughout the years, and this will be the net value of the equipment. We are not going to credit the equipment for any changes in depreciation. Instead, we're going to use the contra asset account accumulated depreciation. Next, we have unearned revenue. Unearned consulting revenue. We were given a deposit of $3,000 in order to perform some work for a client, but we had not done the work at the time they gave it to us, so this is a liability. But as experienced accountants, we know that we have earned some portion of this throughout the month, so we need to bring the books up to date as of month end. So let's look at that. Unearned revenue represents a 60-day contract. 5 days have passed at month end. So $3,000 divided by 60 days means that we're earning $50 a day. 5 days have passed, so this means that we can recognize $250 of revenue. So we will recognize consulting revenue in relationship to the unearned revenue. We'll decrease this liability and increase the revenue. And we'll look at the journal entries. I'm just explaining them right now. Next, we know that our employees are earning salaries even since the last time we paid them. So now we have to take into consideration the employees which are helping us earn the income, so we need to match the expense to the income, our matching principle. So employees earn $700 for a 10-day work week. 3 days have passed at month end, so $700 divided by 10 days means that $70 a day is what we pay our employees. 3 days have passed at month end, being before month end. So at month end we have 3 days that we haven't paid them for. So this means that we'll have a liability for salaries of $210, and also our salaries expense will increase by $210. Now, if I'm going a little too fast for you, remember you can always pause the video and then restart it after you've had a chance to look at everything. And our sixth and final adjusting journal entry, and again, these are the only 6 that we're going to learn about in this chapter. So these are the only 6 that you will be responsible for learning and knowing. The company is working on a job which is not yet completed, neither have they billed the client because they haven't completed it. But they have worked for 20 days on a contract by month end. So at month end, they've worked 20 days on this contract. The company is paid $90 per day, and they've worked on it for 20 days, so that means they should recognize a receivable of $1,800 and revenue in the amount of $1,800. So let's look at these journal entries. So our prepaid insurance, we know that we have to recognize and match with our revenue, our insurance expense, and that our prepaid insurance, $100 or 1 month of the policy has elapsed. So now we have to reduce our asset. We have to credit our asset, prepaid insurance, in order to recognize that $100 has lapsed, and also we have to recognize that our insurance expense has increased by $100, so we're going to debit the expense. Next, we're going to debit supply expense to recognize the fact that our expenses for supplies have increased, and we will also be reducing the supplies as an asset, bringing it down to its proper value because we only have so much on hand, and $1,050 of the supplies have been used during the month. And we will also look at these adjusting journal entries in relationship to the general ledger T accounts in order to see that everything's properly valued. Next, we're going to increase the expense associated with depreciation. So increasing an expense means that we will debit it. And then we're going to use our contra asset account. Contra asset account will mean that it'll be credit based because typically what increases an asset is a debit. So a contra asset account will have a credit base. So whenever we're increasing the contra asset account, we will be crediting that account. Next, we have to recognize the fact that we no longer owe $250 on the unearned consulting revenue. So when we're decreasing a liability, we're going to debit it. And then on consulting revenue, since we're increasing it, we're switching it from unearned to regular revenue, we're going to recognize the fact that this is increasing, so we're going to credit the account. Additionally, you may want to pull out your accounting equation if the debits and credits are not making sense to you. It's always good to have that close at hand as we're learning debits and credits. Next, salary expense. $210 salary expense is increasing, so we're going to debit it, and now we have a payable because we haven't paid them yet for this. So we have to increase the payable, which is a liability, so increasing the liability means we will credit it. Next, let's recognize the accounts receivable work related to the job that we've not completed and not billed, but that we have been working on. So accounts receivable as an asset will be debited, showing that it's increasing. Consulting revenue as a credit will be increasing, so as a credit-based account, we will increase it by crediting it. Now, let's look at these adjusting journal entries in relationship to our general ledger accounts. And what I have here are the unadjusted trial balances that we are all bringing forward. And then we're just going to record in these all of our adjusting journal entries. So here we have insurance expense that we are debiting. So debiting insurance expense. Prepaid insurance, we're crediting it because it's going down. So originally $2,400, now $2,300. So we know that's properly valued. So if we asked for our money back from the insurance company, they would only pay us $2,300 since a month has lapsed and we've used $100 of coverage. Next, let's look at supplies expense. Our supplies expense is going up because we used $1,050 in supplies, so our adjusting journal entry increases supply expense. And next, let's look at what it's doing to the asset office supplies. We originally had purchased throughout the month $9,720 of supplies, but we've used up $1,050. And remember when we did the count, when we counted the office supplies that were still on hand, it was $8,670. So it makes sense that this account now has a balance of $8,670. Next, let's look at depreciation expense. We know that it's increased by $375, and here's our accumulated depreciation account. Again, contra assets, so it's going to be credit-based because all of our assets are debit-based. So $375 for accumulated depreciation. Unearned consulting revenue. We have decreased the amount that we owed because we've worked on this contract and now we have earned $250 of that contract. So here was our original contract for $3,000, our adjusting journal entry for $2,500. Now we only owe this client back $2,750 if they were to rescind or cancel the contract because we have done some work on it. And also we get to recognize an adjusting journal entry, $250, saying that yes, we've earned an additional $250 in addition to the original $5,800 we had in the account. Next, let's look at the fact that we have our salaries, our employees have been working and we have a salary expense. We haven't paid them yet, so we have to recognize that we have to pay them, but we also have to recognize the fact that that expense has been incurred and it's helping us to generate our revenue. So our salaries payable will be $210. Now, when we subsequently pay our employees their regular payroll, we'll have to take into consideration the salary payable when we pay them because we will no longer owe it once we pay them. So when a salary straddles a month end or a year end and we create a new payable, when we finally do pay it in the subsequent month, we must take that into consideration when we prepare the journal entry associated with paying the payroll for that month. And we're also recognizing the fact that salary expense has gone up by $210. Next, we have the accounts receivable for the contract that we've been working on. We haven't billed the company, but we get to recognize in our books an accounts receivable for $1,800. And we also get to recognize that we have an additional $1,800 that we have earned in revenue at month end. So the whole process is meant to bring the books into good order so that all of the assets and the liabilities will be properly valued and we will have accumulated the proper amount of revenue and expenses associated with month end. Next, let's look at how this integrates with the adjusted trial balance. We have our cash amount. Now we have our accounts receivable. We see that office supplies are now $8,670. Prepaid insurance has been adjusted. Equipment It's still the same 26,000. It will remain at 26,000 unless the equipment is disposed of or otherwise gotten rid of. And then accumulated depreciation, it will be on the credit side of the adjusted trial balance, but it's associated with the equipment. Next, we see the accounts payable, our salaries payable, the fact that our unearned consulting revenue has gone down, our capital has not changed, our withdrawals haven't changed, our consulting revenue, however, has gone up, rental revenue is the same, we have our depreciation expense that we are recognizing for the first time, salary expense has gone up because we had additional salaries associated with generating or earning this income. We had the insurance expense associated with that income, rent expense, supplies expense, and utilities expense. So we had to properly bring up all of our expenses to match it with the revenue that we